What is up, you guys? It's been a bit since we've done a deep dive on a company, and today I want to talk about TDOC. This is a company that I actually have had a couple of people within our free Discord community ask me to do. If you guys have any tickers you want me to go over looking at long-term fundamental analysis, join our Discord community. It's completely free. Once you're over there, go into the long-term chat section, tag me, and I will end up doing a long-term analysis if enough people want me to do one. Today, we're talking about TDOC, which is up 8% today, but over the past year has been falling off of a cliff. We hit highs last year during November of $156, and at one point we were trading up around $291 on 2/16/2021. This is a company that performed very well off of the pandemic, obviously, that got to some astronomical overvalued levels, and since then has dropped down below where it was during the before the pandemic. So before the pandemic, back here in 2019 December, basically beginning of 2020, we're trading at $82 per share, and as of today, even after an 8% rally, we're only trading at 27 bucks. So a lot of people have been asking me, is this a stock that's worth getting into, or is it a company that's going to really be burning a lot of money, or potentially not have a wide enough economic moat for other companies to come and knock them off? So what we're going to be doing today is just a brief overview, a brief analysis of this company, looking at some of the financials, looking at some numbers they would have to put up in order for me to enter into a long-term position, and ultimately what price I would need it at. So hit the like button and let's get started. So big company, not massive, market cap $5 billion. If you guys don't know what this company does, it's basically a telehealth company, and it's an app and or a software where you can basically talk to your healthcare provider that delivers 24-hour on-demand healthcare via mobile devices, internet, phone, etc., etc. I did a lot of this during the pandemic when I actually had COVID. I talked to my doctor via TeleDoc. I've had this multiple times before, and it's a really good service, to be quite honest. Like, I've used the service. I hate going to the doctors. I hate dealing with all that shit. But actually, TeleDoc was a really, really solid service. Market cap is $5 billion. Revenue trailing 12 months is $2.23 billion, which is very nice. But the net income is $9.87 billion loss. So they are burning money. They lost 4 times what their revenue was for the year. They lost double the market cap of the company, right? This is something you have to take into account. You can have a great company and a great idea, but if the company is just freaking burning cash, it's not going to be good for you. PE is non-applicable because there's not a profit. A 5-year PE is NA because there is no profit. The profit margin is negative 441%. The 5-year profit margin is minus 202%. So you can see that it's getting worse, actually, which is never a good sign. Gross profit is 68%. Price to sales is 2. Free cash flow, 106 million. Obviously no dividend. Return on equity is a loss of 85%. There is no return on assets. And when you look at this, it's not hot. I'm just gonna be honest. It's not hot. Company that's burning 4 times the amount of money that they made this year in revenue on the top line and burning 2 times what the company's market cap is not a solid move. Looking at the income statement, you can see the operating revenue is growing, which is a very good sign. 2020 it was 716 million. 2021 it was 1.6 billion, so doubled almost, so a little bit more. In 2022 it has grown at a significant rate as well, which is very, very good. Net operating income, you can see here, in 2019 was negative 28 million. 2020 was negative 37 million. 2021 was negative 81 million, and 2022 is negative 47 million. So without this one-off occurrence, you can see here the company is equally burning cash for the amount that they're growing. So what you really want to see, obviously, is that a company is going to make more money in operating revenue, but they're going to ultimately end up losing less money when it comes to net operating interest. You don't want to see net operating income going up, so they're losing a shitload of money, but they're also making a lot of money. You really want to see those be inverse numbers, obviously. Now, looking at the balance sheet, one of the things you can see, cash and cash equivalents is $881 million. Cash and short-term investments is $883 million. Total current assets is $1.26 billion, and total assets is $8.1 billion. Now, if we look at the total liabilities, is 2 billion versus 8 billion. So on the balance sheet, yeah, that's great, but the issue is, it's 4 times their current total liabilities, but the company's still burning cash, right? It'd be a different story if the company was profitable and they have all that money on the balance sheet. That'd be great. Now, things seem to get worse. 5-year PE, don't worry about that. Revenue growth for the past 5 years is good. Net income growth is negative and terrible. Loss of 9.75 billion. Now, something else I want you to understand here is your shares outstanding. They have diluted the living hell out of their shareholders. And the way that a company raises money when they're burning money at this rate is they either go and take a loan or they issue more shares out to the public, which is going to dilute shareholders. So if you are a shareholder within TDOC, you are being diluted at a very aggressive rate. Shares outstanding is 195%. It's very, very high. Now, let's go through some analysts. Well, we won't do estimates, actually. Let's just go through the stock analyzer and take a look at what we would potentially hope that this company would be worth. I'm just going to be honest here before we actually start plugging some numbers. This is all arbitrary. This company is burning through so much money that it's very hard to even do these. So we're going to try to, but let's look at this. So revenue growth over the past 5 years is 61%. Over the last year, it's 37%. So you see revenue growth is getting worse, which is not good. As we end up seeing our profit margins getting worse. So we're going to run through low, mid, high. So low numbers over the next 10 years for revenue growth. A low number would be something like 10%. A medium number would be 20%. A high number would be 30%. Profit margins, negative 441%. Let's say the low side, the profit margin would be 5% positive. They're very far from that. Profit margin would be 10% medium and then 20% on the high side, which they're nowhere near that. Free cash flow would have to be same 5, 10, 20. The PE ratio, let's say PE is at 10, 20, 25. Price to free cash flow would be 10, 20, 25. And we're looking for at least a 15% return on our money. And if we run those numbers, you will see, and this is where I don't want to get, shit twisted for you guys. You will see here that if you believe the middle is going to happen, the middle, which would be this, 20% revenue growth, 10% profit margins, 10% free cash flow, trading at a PE of $20 or 20, then buying anything under $60 right now is a steal. Now, I want you to understand that we are so far away from that mid number right now. We are so far away from the low number that I would not pay that much for this stock at all. Not at all. Even looking at the low number, the low side, $12 is still a little high for me. Looking at this company, it's such a gamble. I would probably just not buy it, even if it went down to $5. I think there's a very big chance, further looking into the financials of this company, that it actually goes out of bankrupt potentially. But I would need probably at least $12 for me to want to take the risk, and I would only risk a small amount of money, to be quite honest, on TDOC. I like the company, which I hate. I hate when I like the company and it's at a great valuation, and I've been telling myself I'm going to buy this stock after not really looking at it. Like, I'm not going to just take a position not looking at it, but I've always been like, oh yeah, TDOC's going down. I'll add that to the mental watch list, and maybe I'll buy it. And now looking at it, I would not buy TDOC. Doesn't mean there's not a lot of money to be made, but I feel that like there are so many odds stacked against me as an investor investing in this company. Is still, even being where we are right now, it's not worth it. I would need it down to like $12. And even at that, I think the chances of the company going bankrupt are pretty damn high. I hope this video helps, guys. Comment if you completely disagree with me. I would love to hear from you. Give me your bullish thesis, and comment if you hate what I have to say about this stock. I would love to hear from you guys. So hit the like button, subscribe, and I'll see you next time. Peace.